So let's say you've got 5 lakh rupees sitting around to invest. You obviously want to keep it safe from the wild, unpredictable swings of the stock market, but let's be totally honest here. You also want a much better return than what a standard traditional savings account is going to give you. So where do you actually put it?
It's the classic investor's dilemma, right? We're all chasing that sweet spot. Better returns than a bank fixed deposit, but way less volatility than stocks. Now, you've probably heard people throwing around the idea of corporate bonds as a solution. But the second you start looking into them, boom, you hit this massive wall of jargon. NCD, coupon, yield, maturity. Honestly, it can sound like a completely foreign language. And the big question remains, are they actually safe, or could you lose your hard-earned money?
Well, welcome to today's Explainer. I'm super excited you're joining us because today we are going to build your understanding of corporate bonds right from the ground up, and we're doing it entirely without the confusing jargon. By the time we wrap this up, you'll know exactly how these instruments work, the real risks involved, and most importantly, whether they actually deserve a spot in your own portfolio.
Okay, let's quickly lay out our roadmap for today. We're going to cover 1. What are corporate bonds? 2. Decoding the bond jargon. 3. The 6 major risks. 4. Corporate bonds versus FDs. And finally, 5. How to invest safely.
Starting right off with Section 1. What are corporate bonds? Let's dive into the basics of borrowing.
So, imagine a big company needs to raise, say, 1,000 crore rupees for a massive new project. Instead of just going to a bank for a loan, they decide to borrow directly from investors like you. And this right here is the absolute foundational distinction you need to make. When you buy a company's shares, you're a shareholder. You own a piece of the pie, and your returns vary based on how well the business does. But when you buy a corporate bond, you are strictly a bondholder. You're just lending them money. The company legally promises to pay you interest on fixed terms. Simply put, share equals ownership. Bond equals lending. Moving on to Section 2, decoding the bond jargon. Time to make some sense out of those intimidating acronyms. All right, let's tackle a big one you'll see practically everywhere. NCD, or non-convertible debenture. Now, in the Indian market, you'll hear corporate bonds and debentures tossed around interchangeably all the time. But that specific word, non-convertible, is absolutely key. It means this particular debt instrument will never suddenly transform into equity shares. If you invest in an NCD, you don't magically become a shareholder down the line. You stay strictly in your lane as a debt investor, a lender, for the entire life cycle of that investment. Next up is yield to maturity, or YTM. Look, please don't confuse this with the coupon, which is just a fancy word for the fixed interest rate the bond pays. YTM is actually your estimated annual return based on the precise price you paid for the bond today, assuming you hold on to it until the very end. But here is your quick warning. YTM is an assumption based on math, not a magically guaranteed return. Let's actually put some real numbers to this so it clicks. Say a bond with a face value of 1,000 rupees pays a 10% coupon. That's 100 rupees a year, right? But what if you grab that exact same bond at a discount in the secondary market for just 950 rupees? Now, you only paid 950 rupees to get that same 100 rupee annually, plus you still get the full $1,000 back when it matures. Because of that discount, your effective yield to maturity gets pushed significantly higher than that stated 10% rate. Okay, let's look at another incredibly vital distinction. Secured versus unsecured bonds. A secured bond is backed by very specific company assets, meaning if the company completely defaults, you actually have a legal claim over that physical collateral. An unsecured bond, well, there's no specific collateral tied to it. If things go terribly wrong, your recovery merely depends on whatever general assets the issuer has left. So I urge you, whenever you're evaluating a bond, you have to ask, what exact security is backing up my hard-earned money if this company goes under? And that ties perfectly into our next point, senior versus subordinated debt. Listen, if a company faces insolvency, there is a very strict, legally defined pecking order for who gets paid back first. Senior debt gets the VIP treatment, highest priority claim. Subordinated debt sits much further down the line, meaning it inherently carries way greater risk. And this is why you must always ask why a company is offering a really high yield rather than just blindly chasing the interest rate. Often that juicy double-digit yield is there for one simple reason: the debt is subordinated. Which brings us to Section 3, the 6 major risks. Time for a little reality check. Let's take off the rose-tinted glasses for a second. Corporate bonds aren't just some risk-free money glitch. You actually faced 6 specific risks here. 1. Credit risk. meaning they could literally just miss their payments. 2. Interest rate risk. If general market rates go up, the value of your specific bond goes down. 3. Liquidity risk. Finding a buyer to take it off your hands isn't always quick or easy. 4. Reinvestment risk. 5. Inflation risk, where that nice fixed return actually loses real purchasing power over time. And 6. Call risk. The company might unexpectedly decide to just pay you back early.
So all of that boils down to one crucial point, summarized perfectly right here. A credit rating is not a guarantee that you will get your money back. We've all seen those shiny bonds labeled AA, which generally signify a very strong assessed capacity to meet financial obligations. But look, market conditions change. Even highly rated companies can stumble, and those ratings can get downgraded fast. A credit rating should only ever be one single piece of the puzzle in your overall analysis.
Moving right along to Section 4, corporate bonds versus bank FDs. Let's do a direct comparison. Now, the differences between these two are literally night and day. While a fixed deposit gives you a locked-in rate and zero market price fluctuation, a traded bond's yield is actually going to fluctuate based on its market price before maturity. But here is the absolute kicker. Bank FDs have DICGC deposit insurance. Corporate bonds absolutely do not. A corporate bond is not just a souped-up FD with a slightly higher interest rate. The fundamental risk structure underneath it all is entirely different.
Finally, Section 5. How to invest safely. Let's talk about navigating the actual market.
So when you're ready to jump in, there are two main routes you can take. The primary market is when you apply directly through a company's initial public issue. You review the documents, see if it fits, and apply. The secondary market, on the other hand, means you are buying listed bonds from other investors on an exchange. The big catch here, in the secondary market, liquidity and trading volumes can vary wildly, so you have to be extra vigilant about the actual price you're paying.
Oh, and I want to quickly clear up a massive beginner mistake right here. Buying an individual bond means you have direct exposure to one specific company. And if you hold it to maturity, you know your fixed maturity value. But a corporate bond mutual fund, fundamentally different beast. It's a basket diversified across many different issuers, which spreads out your risk. But because of that, the fund's NAV, or net asset value, fluctuates daily, and there is no fixed maturity value promised to you at the end. Don't make the mistake of thinking a bond fund acts exactly like a single bond.
Okay, before you ever even think about hitting that buy button, you need a solid framework. So here is your definitive checklist. 1. Check the issuer and their credit rating. 2. Look at the effective yield based on the price, not just the stated coupon rate. 3. Verify the security and seniority. You have to know exactly where you stand if there's a default. 4. Assess liquidity. Can you actually sell this thing if you suddenly need cash? And 5. Read the offer document. Seriously, I cannot stress this enough. Never, ever invest just because some brochure promised you a flashy 10% return with actually reading the fine print.
Which naturally brings us to the absolute golden rule of fixed income investing. Don't chase yield. Period. A higher return almost always comes wrapped in higher risk. If one bond is offering you 9% and another is screaming 12%, that extra 3% isn't free money. It's compensation for taking on more risk. You have to start thinking like a true lender and demand adequate compensation for risking your capital.
Well, we've covered a massive amount of ground today. Now I want to turn it over to you and your own portfolio. If a major economic shift happened literally tomorrow, are your fixed income assets truly protecting you, or are you secretly taking on hidden risks just for a tiny little bump in your yield? You've got to weigh the rock-solid safety of FDs against the wealth-building power of bonds and make the choice that empowers your specific financial future. Thanks so much for joining me on this explainer, and as always, keep learning.